The Morgan Report with David Morgan.
David Morgan, themorganreport.com, 27th of February, 2021. I am on the Twitter account and just pointing out a few things I posted this week. On the 24th, can the COMEX default when it cannot get metal to fill its contractual obligations? No. The natures of futures contracts and the COMEX rules make it clear that futures exchanges could just elect to settle in cash. There's a link there. I won't press it. Talked about 1,000-ounce bars. This one's important. This is from Wall Street Silver. Thank you. Open interest dropped drastically, right in line with what happens every delivery month. I mean, I made sort of a joke, and I was also open to the idea that maybe there would be more people or contracts that were standing for good delivery bars, and that's not what happened. At least what we know so far, it didn't. So we see what we normally see. I mean, I've been hearing for a long time that, all that has to happen is for people to stand there and take delivery. Well, that's partially true. The rest of the story is that there is a limit. As Jeff Curry said, it is 7.5 million ounces. So if they were standing for 10 times that amount, I don't know what the exchange would do, but I doubt they would deliver all that. Anyway, it hit Friday really hard. As you could see, gold was off about 2%, silver was off 73 cents, about 2.5%, and platinum and palladium were also off more than 2% at the close of the market Friday. So I said I'd talk about silver. This is the Commitment of Traders report as of the 23rd of February, just a few days back, and it goes through the week, so it isn't as of that date. It's published on that date, going to the end of the prior week. So we can see from this that the commercial interests here, which is the banks, they have reduced their short position by 5,500 contracts, but they also reduced their longs by 45. So really that's a net of 1,000. So I wouldn't say they're doing a ton of covering. If you look at the trading funds mostly, that's the non-commercials, they reduced their long position by about 3,000 contracts. So some change going on, not all that significant, and I'll show you here on the next chart. So the blue is the commercials, and the red is the funds, basically. And you can see that on the open interest, which was very high when we got that spike, that was very high on this spike here. This is price. You can see normally on the open interest, it can be on the big ones, it's usually high or low, not always. The point I'm making is simple. There's not been a lot of covering on the commercial side. The open interest is still very high, 172 million if you looked at that last image that I showed a moment ago. So usually when we get at a inflection point where most of the short covering has taken place, we're down in these ranges here, like the 140 or so. It's constantly changing. It used to be always almost the same amount of open interest, up and down, up and down, up and down. That's changed. Although you can still, going back, about a year, you could kind of see, it's like that's top, that area, that area, that area. It doesn't always correspond at that time exactly to what's going on, but you get an idea here. So anyway, the commercials are basically holding tight, rolling over, and still significantly short. So I just want to point out on this one a little bit on this pretty simple chart here. This is the warehouses vaults for the COMEX, and you can see this is a 1-year chart, that the amount of eligible has basically stayed flat for quite a while, and it's increased here recently. And then the amount of registered, which has been about the same, flat for some time, and decreased recently. So that suggests, obviously, that some of the dealer inventory went into the long-term holder inventory, although it doesn't have to. In other words, you could go and fulfill the contract by getting a refined good delivery bar from a refiner and going directly into the eligible, or for that matter, into the registered. So not everything that's on the COMEX stays on the COMEX, but generally speaking, it does. Some news: CNBC, gold slumps as rising U.S. yields, dollar dull luster. There is a bit of concern, and I think rightfully so, that we're seeing an increase in interest rates, which means bond prices go down. The 10-year is sort of the main focus of anyone in the financial world that really understands what's going on with the system at large and why it is vulnerable. So nothing to get that excited about yet, but gold was off 3%. As I showed you when I opened this up, spot gold off 2.5%, futures settled lower, struggling to do what's going on in the bond market. Or, excuse me, gold is struggling due to what's going on in the bond market. Somewhat true. I won't argue that. 10 years, I just said, held near their highs in over a year, while the dollar index also jumped. Rising inflation expectations has lifted U.S. Treasury yields by more than 70 basis points so far this year. So, as I've always said, the bonds are the keys to the kingdom. The debt markets are the number one problem. It's debt we can't pay back, and why you should own gold. Just because gold reacts the opposite here on Friday doesn't mean we're there yet. Will it eventually have a marked change due to interest rates? And the answer is probably not. And here's why. In the 1980 run-up, where gold was going exponential and a lot of people were moving into the gold market, Volcker came in, as many of you know, and some don't, new people, and put the interest rates up near 20%. It just crushed the gold market, and crushed it for years, really. You couldn't do that this time. And the reason you couldn't do it this time is the governments would be unable to pay back their debt, which they already are, but the bond market would collapse. There's no way that you could pay that kind of interest. Though, as interest rates go to 20%, the value of the bonds go down, and they go down so far, it'd be ridiculous. So the main thing I think to look at is what is not the nominal interest rate, which we're pointing out, but what is the true interest rate? And if you use the government's numbers, then we're kind of flat on the 10-year. If you use Shadowstat's numbers, and we're looking at probably true inflation of 9%, looking at food, energy, and the way it was calculated in 1980, we'd have to get to that level in the bond market in order to be at par, meaning that the interest you received on your 10 years would be equal to the true inflation rate. And you're not going to be able to see a 9% yield, in my view. I don't think it could ever get there. It will collapse the bond market. So a lot to look after. I don't think gold is going anywhere but up longer term. But there is turbulence in the market right now. I won't deny that. Gold's acting weaker than silver, but it's still probably the best hedge for currency problems as it continue. Deflation.com, I don't cover it very often. It's a good article. It's about a 3-minute read. Deflation, the demise of cash. And another, CNBC, Dow drops more than 460 points, as we all know. On Friday, everything was off, as I started showing what the metals did. So we're in a situation, a lot of people are confused, and that's exactly the place to be, confused, because we are seeing inflation in some areas, deflation in other areas, stagflation in other areas, and it's really hard to get a handle on this as far as what's really going on. But keeping it simple, money printing continues at a phenomenal rate, which depreciates the currency. People that are out of work, of course, are having a tough time, struggling because they're not getting any, or they're getting modest payments from the governments, depending on where you are on the planet. And so it's basically a mess. And the trend in motion usually continues, which means it's probably not going to get better for a while. And I'll finish with this. Great respect for this man. I've never met him. I hope to sometime, but who knows. But Charles Hughes Smith of TwoMinds.com, Oil and Debt, Why Our Financial System is Unsustainable. I'd say if you're going to read any article this weekend, that would be one to do. And I'm going to sign off here at 10 minutes. I don't want to keep these too long or boring. So remember, there's nothing more powerful than the truth. We get a very, very limited amount of it these days with what's going on in the social media and the mainstream press. But think for yourself. Don't be afraid to stand up for your beliefs and live with honor. It's a rare commodity these days. I'll be back with you next week with another weekly perspective. This is David Morgan of themorganreport.com.